Hello everyone and welcome to episode 2 of our Traders Workshop, where in today's session we're going to be talking about interest rates. Now, interest rates if you're trading currencies are a very, very important component traders must understand to know if you're going to be making a profit or a loss every single day in your trading account when you hold that trade overnight, because there's a thing called the carry trade rollover, which is basically the difference in interest rates between two countries and how that affects when you buy or sell an exchange rate. So we understand what an interest rate is. An interest rate is set by a country central bank and it has a lending rate and a deposit rate. So let's say you want to deposit money into your bank account, you're going to receive an interest rate which is called the deposit rate. And if you want to borrow money from a bank, they're going to charge you an interest rate which is called the lending rate. And this basically sets the cost of a country's currency. So let's say we have the Great British Pound and we have the US dollar and we're trading this specific exchange rate. If I wanted to buy the pound, I'd have to first own dollars, sell those dollars in exchange to purchase the British pound, and the amount of dollars that I'm borrowing as the funding currency to buy the pound, I have to pay the lending rate that the US central bank charges on those US dollars, and then I'm going to receive the deposit rate that the Bank of England pays on its currency. So that basically means that when you're trading a specific exchange rate, you're going to either be paying out of your account a debit or you're going to be receiving a credit into your account based on the difference. So of course that means that we want to be buying one currency against another currency where the currency we're purchasing has a higher interest rate than the currency we're using as the funding currency. Because remember, we're using the dollar for an example to buy the pound, so we have to pay the lending rate in the United States and we receive the deposit rate on the pounds we're purchasing from the Bank of England. That's a positive carry overnight. So every night over 365 days, you're going to receive a credit into your account of the difference if I buy a currency with a higher interest rate than another currency. On the flip side, if I'm buying the dollar against the British pound and the pound has a higher interest rate than the US central bank, then again, I'm going to be losing money overnight because I'm paying out more money for the pound I'm borrowing to purchase my dollars and I'm receiving less interest on the dollars I'm purchasing. So we've created Excel spreadsheets explaining this in detail so you can, whenever you go in to take a trade in the markets, you can take the interest rate for the United Kingdom, you can take the interest rate for Australia, you can compare the two, and then you can put in this Excel spreadsheet that I've created the amount of lots that you're trading on the position, how much you're trading in your account, and it's going to automatically work out for you straight away how much you're going to be paying out of your account or receiving into your account based on the difference in interest rates. Then I've also given you a spreadsheet looking at historically the Aussie dollar against the US dollar going back to the 1970s, showing you that when interest rate differentials, so the difference in interest rates between two countries, when they widen in favor of one currency in terms of one country's current interest rate is higher than another country's interest rate, how that really sets trends in the market. So you're going to start to understand why trends really pick up and why one currency really appreciates in value against another currency, and then why a trend can reverse when the interest rate differential either goes in the other currency's favor or depreciates in the currency's favor, which did have a higher interest rate. So it's really important to understand, because again, it's going to basically mean, are you making money or are you losing money just by holding the trade overnight and rolling it to the next day? So extremely important. As soon as you get this fundamental analysis down, you're really going to start to observe the markets in a complete different way, and you're going to be trying to buy currencies that have a higher interest rate than another currency. And basically the higher interest rate is telling you most of the time that that country is experiencing high growth or high inflation, which is very positive unless it's out of control. So guys, we're going to take you over to the computer screen. I'm going to break this down for you in more detail. I really do hope you do take this spreadsheet for yourself, because it will massively help your currency trading if you are a Forex trader. And I look forward to hearing from you and getting some feedback from you. So we're going to go over to the computer screen. I'm going to break down interest rates, the carry trade rollover, and show you the Excel spreadsheets. Thank you. Okay guys, so welcome to this video where we're going to touch on the interest rate carry spreadsheet that we have available for you guys. That's really going to help you understand how much money you'll be making every single night when you hold a position from one day to the next when you're trading a currency pair, or how much money you'll be losing overnight when you're trading a currency pair in the forex market. So interest rates are very important. It drives the value of currencies, but most importantly, you need to understand if you're making money overnight or losing money overnight. Otherwise, you could be taking a position in the markets which is actually going in the right direction, but because you don't understand interest rates, you're not actually making any profit, because the amount the exchange rate may be going up, maybe being cancelled out by the amount of money you're losing out overnight. So I'm going to do a short run through on interest rates, which is very basic, very easy to understand. Then I'm going to give you some examples of interest rates and how they drive the value of currencies. And then I'm going to give you a run over of the actual spreadsheet I've created for you. So every single time you go into a trade into the markets, you go into this spreadsheet, you put the different interest rates in, and it's going to tell you, are you making money or are you losing money? And then you're going to understand the only time you want to be buying a currency against another currency with a lower interest rate is when the other currency's interest rate is expected to go lower. Okay, so it's going to give a big broad overview, but you'll definitely find it's very helpful towards your trading. So here we're going to look at the United States and Australia. Okay, then in the United States, this is just a hypothetical example. Let's say the interest rate in the US is 2.5% and the interest rate in Australia is 0%. So the interest rate is set by the central bank. So you have the Federal Reserve of the United States, and then you have the Reserve Bank of Australia in Australia. So the interest rate simply sets the cost of borrowing money. So if you want to borrow money from the bank, or if you want to borrow in the currency, if you want to borrow the currency of that country, you would have to pay 2.5% when you borrow US dollars in the marketplace. Okay, so let's say you want to borrow money from a bank, you're going to have to pay 2.5% over an annual 12-month period for the amount of dollars that you borrow. Or let's say you want to deposit money into the bank, you're going to receive around 2.5% interest on the amount of dollars that you're investing in the United States. So you have the deposit rate and the lending rate. Now, of course, usually the lending rate is slightly bigger than the deposit rate, but just as an example, we've set them at the same rate, obviously because a bank's always going to lend you at a higher rate than they pay you, so the bank makes money on the difference. But hypothetically, we're just saying 2.5%. Now, let's say in Australia, the interest rate is 0%. So if you're putting money into the bank, you're going to receive 0% interest on your money. Or if you lend money from a bank, they're going to charge you 0%. So why do different countries have different levels of interest rates in their domestic economies? Well, obviously it's all to do with inflation. So the central bank has a mandate to maximize employment and keep inflation around their target, which is usually around 2% per year. So if, for an example, interest rates in Australia are 2% are 0%, this basically means they're trying to make money very easily available for businesses and households to get credit and spend that money in the economy to try to drive up growth and get inflation around their 2% target. So low interest rates are usually because inflation is quite low and nowhere near the central bank's target. However, if you had interest rates in the United States at around 2.5%, this would usually be around because the economy is very strong, the demand for goods and services is high, and inflation is around their target. So they have an interest rate at a certain level to try to contain inflation to be around their target. But what we need to understand is that when we're looking at an exchange rate, so if we're looking at the dollar against the US dollar against the Australian dollar, what we need to understand is that if I was to buy the US dollar against the Aussie dollar, or buy the Aussie dollar against the US dollar, you're going to have to pay money for the currency you're lending to finance the purchase of the currency you're investing in, and then you're going to be receiving interest on the currency that you're buying. So let's say for an example, I want to buy the dollar against the Aussie dollar. In order for me to be able to do that, I have to first own Aussie dollars, and I sell my Aussie dollars in exchange to buy US dollars for me to invest in the US dollar to go up in value against the Aussie dollar. But remember, the lending rate in Australia is 0. So if I own Aussie dollars and I sell my Aussie dollars in exchange to buy US dollars, I'm going to be paying 0% interest on the Aussie dollars I'm using as the funding currency to purchase my US dollars. And then I'm going to receive 2.5% interest on the amount of dollars I've purchased over an annual 12-month period. So clearly we can see that if I was to buy the US dollar against the Aussie dollar, if this was the interest rate set in the United States compared to Australia, it would be profitable for me to buy the US dollar against the Aussie dollar, because over 12 months, I'm going to receive 2.5% interest into my trading account for buying the amount of US dollars I'm holding, and I'm paying out 0% interest on the Aussie dollars I've used to fund the purchase of my US dollars. So that really makes sense. So then automatically we can see, if we reverse this trade and we was to buy the Aussie dollar and use the US dollar as the funding currency to purchase the Aussie dollar as the investment currency, I'm going to be losing money over an annual 12-month period, because of course I have to pay 2.5% interest on the dollars I'm using to fund the purchase of Aussie dollars, but I'm receiving 0% interest as the deposit rate for the Aussie dollars that I'm buying. So clearly we only want to be buying a currency against another currency if the currency we're investing in, the deposit rate is higher than the lending rate of the currency we're using to finance the purchase of the currency we're buying. So clearly it's a smart investment to purchase the US dollar against the Aussie dollar, because you have a positive difference in interest rates when you're buying the US dollar. On the flip side, if we buy the Aussie dollar, it's a negative trade for us, because overnight, over every single day, over 12 months, we're losing money because we're receiving nothing in our account overnight as a deposit rate. But for the US, we're paying out 2.5% as the lending rate. So this is very important for us to understand. And what we have here is we have another spreadsheet showing you how the difference in interest rates can really drive the value of currencies in an exchange rate. So here we have the date going back to 1976. We have the US central bank's interest rate, the Reserve Bank of Australia's interest rate, the difference between the two, which is literally Australia's interest rate minus the US interest rate, and then you get the difference. And then we have the basically the amount of money you're paying into your account or paying out of your account on a day-to-day basis if we took a one lot position in the markets. And what you can clearly see is, when we look at this, here we have the difference in interest rates, and then here we have the amount we are paying into our account or out of our account. And then what I've done is I've shown you this against the Aussie dollar, US dollar exchange rate. You can see the difference between the two. So what we're going to look at here is we can see that when the difference is turning positive, which basically means, for an example, the Australian interest rate is getting higher than the US interest rate, so the difference is widening in the Australian dollar's favor. That means it is more profitable to buy the Aussie dollar over the US dollar, because you get a higher amount of interest into your trading account on a day-to-day basis. And when this happens, as you can clearly see here, this was going higher around May of 2000. And when the difference was widening, the Aussie dollar started to strengthen against the US dollar, because investors are they're looking for opportunities in the markets where they can, first of all, make a profit from the exchange rate appreciating in price, and on the flip side, make money every single night from the difference in interest rates being more positive, say for an example, in the Australian dollar's favor. So the Aussie dollar, US dollar was getting stronger in the Aussie dollar's favor as the difference was getting stronger because interest rates are going higher in Australia. And then around 2004, when the interest rate differential started to narrow, and this could have been either because the Australian central bank was cutting interest rates or the United States central bank was raising interest rates, when the difference was narrowing, we saw the Aussie dollar, US dollar started to weaken. Okay, so again, as you can clearly see here, when the difference was narrowing over a long period of time, the Aussie dollar weakened against the US dollar in the market. So what we can see here is, when we look at our synthetic rollover, which is basically telling us how much we're going to be making or losing overnight, you can see a bigger picture. So again, let's say we was to buy the Aussie dollar against the US dollar around May in 2000, and then over that 4-year period, the Aussie dollar interest rate differential was getting higher in the Aussie dollar's favor. When you bought the currency pair, you would have been receiving no interest into your account overnight. But by the end of the trade, every single day, you'd be receiving $12 in your account if you're only trading one lot of Aussie dollar, US dollar. So clearly, if you're trading, say, millions if you're buying huge amounts of currency, which investors do or hedge funds do or investment banks, and you can see how this can become very profitable, because you're not just making money off the exchange rate going up in value, you're also making money off the daily credit you're being paid into your trading account. And then, of course, when it went from $12 a day down to $2 a day, it's paying you less. Investors want to come out of that trade, and then you see the Aussie dollar, US dollar weaken along the trend. So that's just giving you a prime example, guys, of that. When interest rates are going higher in one country, then money flows in that direction in the exchange rate, because they want to get paid the difference in interest rates, and then that causes the currency to appreciate in value, so you can make money off both the appreciation in the exchange rate and the difference in interest rates. And then when the difference is narrow, then investors want to come out of that trade and try to cash in on their profits from when the currency was going higher. And that's what causes a currency pair to change direction in a trend. But more importantly, we have created this spreadsheet here. Okay, so we did have a previous example, but what we're going to do right here is we're going to have what we did there, where we looked at the US interest rate being 2.5%, and let's say the Australian interest rate is 0%. So what this basically means is that if in the exchange rate, actually, sorry, you have to do it the other way, because of course Australia is the base currency and the US will be the quote currency. So this will be 0% interest, and the United States interest rate in the example we've been looking at is 2.5%. So if I use the Australian dollar as my funding currency to buy the US dollar, in the example that I showed you, you're paying out 0% interest on the Australian dollars you're borrowing to buy the US dollar, and you're receiving 2.5% interest on the US dollars you're buying over an annual 12-month period. So if I buy the US dollar, I receive 2.5% interest. So before you get into a trade, you go into this spreadsheet, you type in the difference between the two countries' interest rates. You can choose how much you're trading. So if you're trading one lot, obviously that's 100,000 units, or if you're trading 10 lots, then you can type in you could type in 1 million units for an example, and that's going to tell you how much you're going to be paying out of your account every day, or how much you're going to be receiving into your account every day. So if I was to buy 1 million units of the US dollar against the Aussie dollar, for an example, you'll be receiving $25,000 into your trading account over a 12-month period, meaning you're being paid $72 per day. On the flip side, if you were to buy the Aussie dollar against the US dollar, you'd be paying out $25,000 over an annual 12-month period, and you'll be losing $72 a day. Obviously, that's a huge amount to be trading, but I'm just giving you an example. So let's go back to trading 100,000 units, which is one lot. Now you can see that if I buy the US dollar against the Aussie dollar, I'll be receiving $7 per day into my trading account, and I'll be paying out nothing because I don't pay any interest on the Aussie dollars that I'm using as the funding currency to buy the US dollar. If I go long the Aussie dollar against the US dollar, then I know I'm paying out $7 per day, and I'm losing $2,500 per year to take that position in the market. So as I did show you guys, when you're trading the markets, the trends that take place in the currency markets are going to be driven by the interest rate differential. So as soon as you understand that, you need to come into this spreadsheet, you need to put the interest rate of the United States in the spreadsheet, you need to put the interest rate of Australia in the spreadsheet, then you type in how many units you'll be trading for the currency pair, or how many lots, and it's automatically going to tell you, are you losing money overnight, or are you making money overnight? And the most important thing we have to remember is that the money chasing certain currencies in exchange rates is always chasing the highest interest rate out of the two. Investors do not want to be buying one country's currency against another country's currency if you're losing money overnight. The only reason they will do that is if the difference in interest rates is no longer as favorable in one country compared to another. So let's say, for an example, Australia's interest rate changed to 1%. Now you know that money would flow out of the US dollar back into the Aussie dollars, because remember, in order to take the trade in the first place, you had to buy Aussie dollars, sell them in exchange to buy US dollars, and then when the US dollar went up in value, you would sell your dollars back into Aussie dollars, and you'd be left with more Aussie dollars than you started with, in order for you to make a profit from that trade. But when the interest rate differential starts to narrow, and let's say the interest rate in Australia is going up, as we showed you, to 1%, then investors know that money is going to quickly come out of the dollar back into the Aussie dollar to cash in on that trade when the exchange rate went up in value, and they're no longer going to be wanting to hold the US dollar because they're not making as much profit per day on the trade. And it's that flow of money chasing the difference in interest rates that drives the value of currency. So this is really, really important, guys, for you to understand. So come into this spreadsheet, go into this section, type in how much you're trading per trade in terms of lots, put the interest rate for each currency into these sections, and you're going to know if you're buying or selling the currency, are you going to be making money or losing money? Just remember, this is over 365 days, okay? So what you want to be doing is you want to be putting the base currency as currency A and the quote currency as currency B, and then you can work out the difference. I'm telling you now, guys, you need to understand this. If you don't use this spreadsheet to put in whether you're making money or losing money, or you don't understand the fundamental trends driving the markets, you could be on the wrong side of this and you could lose money automatically, because trust me now, it's all to do with whether the only way the Australian dollar would get stronger against the US dollar is if the expectation of higher interest rates in Australia started to play out in the markets. So the markets was quickly cashing in on that trade, as I was telling you, selling their dollars back into Aussie dollars. Or the only way the US dollar would get weaker would be maybe that the US central bank is expected to cut interest rates. And again, on the flip side, if Australia had a higher interest rate than the United States at one point, let's just say for an example, if the Australian central bank's interest rate was 2.5% and the US is only 1%, if then the Australian central bank was cutting interest rates to 1.5%, then you know that the US dollar would get stronger against the Aussie dollar. Or on the flip side, if the US central bank started to raise interest rates, then we know automatically the dollar gets stronger. But most importantly, this spreadsheet is about, do you know if you're making money overnight or losing money overnight? And what you do is you come in here, you put the interest rate differentials between the two, you check how much you're trading, and then you see, for an example, if I'm trading one lot, I'm losing this much money over an annual period, or I'm making this much money over an annual period, depending on whether you're buying or you're selling, and this is how much you're paying out or receiving per day. And then you can do the difference for mini lots, nano lots, and micro lots. And it's basically telling you again on an annual 12-month basis how much you're making or losing, and on a daily basis. So guys, this is available for you to purchase on my website. I hope you do get this spreadsheet, because it's very important for you to understand, and it will keep you on the right side of the market. I'll make sure that you won't be losing money depending on which way you trade a currency pair. But this is so important for you to understand, because as I've shown you in the other spreadsheet, this is literally what drives exchange rates. You can see how closely correlated the two are. The difference in interest rates is going to be causing money to chase the higher interest rate paying currency, and when the interest rate difference narrows, as you can clearly see here, then the currency pair narrows at the same time. So hope that makes sense, guys. Thank you for watching, and that is our interest rate spreadsheet for carry trade rollover. Thank you.